Hey guys, welcome back to the channel where we're all about financial freedom. Now speaking of financial freedom, today I'm going to be giving you 5 of the best monthly dividend paying stocks available to buy in the UK, which are perfect for passive income. Now those of you who might be new to investing, a dividend is a profit a company makes paid out to its shareholders. And that can be done typically on an annual, 6-month or quarterly basis, but in some cases it is done monthly. And that monthly payment essentially gives you some income each and every month, which can be a fantastic stream of income for just leaving your money in certain investments. So some of these could be really nice additions to your portfolio if your goal is to get income each and every month. And if you're a long-term investor, you can simply reinvest the dividends, and there is one major advantage with monthly dividends. If you can get the money into your account quickly and start it building up, the compounding effect starts happening sooner and sooner. So the sooner you get that money into your account, the better. Rather than maybe wait 12 months for that dividend payout, you get it earlier and it starts compounding. In actual fact, in my book, that can actually be the number one reason to go for a monthly dividend. Or of course, if you need the income. Before I do reveal these companies, I need to just say I am not a financial advisor. This is my own personal opinion. You should seek financial advice before making any kind of investment, and past performance does not reflect future price. Now with that out of the way, I need to give you some key facts about these investments. Now the first thing you need to know is there aren't that many options available. And you might think, that's crazy, surely there's plenty of companies that are paying a monthly dividend. Well actually, there's not. Well the truth is, for a lot of big companies, there's no point them paying a monthly dividend, and there's no real incentive for them to do this. A big company generally works on an annual basis. They'll have an annual budget and that's what they work to. So once a year they'll see what profit they made, how much they can pay out, and they'll distribute that to their investors. Now what they might do is do that twice a year and sometimes quarterly. It's most common to find it once a year or twice a year in most cases. Monthly is quite rare. So the types of companies you'll find that do this, they tend to be either real estate investment trusts or REITs, which are really interesting in themselves, and I'll do a whole video comparing those shortly. And the other category tends to be corporate loans and securities and government bonds. Now the loans and bonds tends to work on a monthly basis and it's easier for them to pay out that way. Now in terms of the way a REIT or a REIT works, it works a little something like this. So the REIT must distribute 90% or more of its tax-exempt income profits, not capital gains, as well as 100% of any property income distributions received from other UK REITs by the filing date of the company's tax return. So this essentially means in their setup, they have to give away at least 90% of what they make. So you guarantee there's a very high likelihood that they're going to pay out because they just have to, whereas a normal company may choose not to. So you do have some kind of added security in that sense. The other reason in this video I'm mentioning UK companies is as a UK resident, you don't have to pay the withholding tax. Tax, you might say, well my money's within an ISA. Well no, it just doesn't work like that. And this is how it works. For example, the US headline withdrawal rate is 30%, but UK residents are entitled to a reduced rate of 15% if you complete the form W8BEN, which most brokers will get you to do when you open an account. But US stocks held in a SIPP, which is a pension account, can have dividends paid with no withholding tax at all if your broker is set up to do this. So what this essentially means is any dividends you get from the US, you're going to have to pay a 15% tax on. And that's paid before you actually get the money, so you don't even see the tax. So you might be expecting a certain return and then wonder, why have I got so much less? Well, that is why. And it doesn't matter if your money's in an ISA or if it's in a normal account, you have to pay that tax, unless it's in the SIPP. So what I will do in future videos, which I think will be really interesting, is compare UK ones to US ones, and I'll show you an example in this video and see how a US company compares with that 15% deduction applied, and then you can see which ones are best for you. So with that being said, I'm going to dive into the 5 companies, show you which ones I've found for the perfect monthly dividends, and show you a comparison side by side in a nice organised table. So the first one I want to talk about is the BMO Commercial Property Trust, ticker symbol BCPT. Now this is one of the most popular ones that I've seen across all the websites that people recommend, and one I've heard of a lot of times. Now when we look at this, there's something here you need to pay attention to, which is a discount and a premium. Now this is quite complicated to explain, but this essentially means if it's a discount it's good, a minus figure, and the higher a plus it is, the more it's classed as being at a premium. Now that's the simplest way I can think of to explain it. So the discount here is quite good, so don't be afraid of this figure. And the goal of this trust is to provide shareholders with an attractive level of income together with potential for capital and income growth from investing in a diverse UK commercial property portfolio. So this is focused on commercial properties in the UK, it's trying to grow and it's also trying to provide you with that monthly income. And if we scroll down this page, we can see the annual dividend yield is 3.52%. And if we take a look at the performance, you can see the performance over the past 5 or 10 years and see how it's been performing. So you can see it's been on its way up, but it has been quite up and down if you look over a 5-year period. If we scroll down, we can take a look at the trailing returns. Now this shows how much it's made on average over the past 5 years. So while you can see it's had some fantastic years over here, you can see it's also had some not so fantastic years. So on average, this fund has made 0.57% each and every year, which for a normal share, you might think that's really not very good. But for this type of monthly income share, that's actually not too bad. And if we take a look at the charges for this trust, you can see that ongoing charge is 1.68%. So if we hop over to my lovely little spreadsheet, you can see here we've got the name of the. So if we hop over to my lovely little spreadsheet, we can see here we've got the name of the investment, BMO Commercial Property, the ticker symbol, the industry, which is a REIT. Now this is where it gets interesting. So we take the dividend, which it makes each and every year, then we take the average it makes over 5 years, giving us 0.57%. The fees are 1.68%. So the return, when you take these figures into consideration, we've got the dividend plus the average yearly rate minus the fees gives us 2.41%. So although these dividends are monthly, it is actually that 2.41% divided by 12. You don't get that 2.41% each and every month, which we would all love. So doing the maths on this, for every £10,000 you have invested, you could expect to receive £20 per month. So if you had £100,000 invested, you would get £200 each and every month. But realistically, that's probably not enough to live on. So you'd really need £1 million or maybe 500,000 in this account to get your £1,000 or £2,000 each and every month. Now in terms of availability, this one's available on Freetrade, HL and Trading 212. They're the 3 platforms I've checked it on because they're the ones I use. Now with all of these, I think it's important to look at the key information documents and do your research before you buy. Now this is where it gets quite scary, and this is a legal requirement, something they have to provide to show how their trust could perform. So this shows you in a worst case scenario what you could expect to get back over 5 years. So if it all went really bad after 1 year minus 98%, 3 years minus 44%, and 5 years minus 37%. So after 5 years, in a worst case scenario with this fund, you could end up with £919, which is not very good from a £10,000 investment. That's not profit, that's how much you would lose and what you would come down to. Now in the favourable scenario, you would actually make quite nice returns, to be honest. So you made 35%, 13%, 7%. So on average, after 5 years, you would get 14,000 back, which is okay. You're not too worried about what you're gonna get back. It's more about that regular income, and that is what you're aiming for. But what is quite scary with this one in particular, every scenario which isn't their favourable scenario, so the moderate, unfavourable and stress, all results in you losing at least half of your money, which is quite scary in my book. Now this might be quite a good one to buy at certain times of the year when you think property is going to improve, then maybe this is a really nice one to go for. Now sticking on the lines of properties, let's move on to number 2, which is Edison Property Investment Company with a great ticker symbol, EPIC. Again, this one has a nice discount, which is minus 20%, and the objective of this one is very similar to the last one. It's commercial properties, focusing primarily on office, retail and industrial. If we take a look at the annual dividend yield, this one is much more attractive at 5.96%. And if we take a look at the performance of the fund, you can see over a 5 and 10 year period, it's been up, it's been down, and these will move vastly with the property market and what people are buying, what they're renting, and this will move massively with the demand for commercial property, so just be aware of that. And as you can see, if we take a look at the returns over a trailing period, the average return over a 5 year period is minus 2.31%. So although you're getting that fantastic dividend, it actually works out not quite as good. And if we take a look at the charges, you can see the charge ongoing is 1.42%. So if we hop back over to our spreadsheet, you can see I've added the EPIC ticker. Again, it's the same industry, the dividend yield, the 5 year interest, the fees, but actually the return, when you put all these figures together, actually comes in lower than the one before. And this comes in at 2.23%, and your return on £10,000 invested would give you each month £18.58, and you actually need Freetrade Plus to be able to buy this one, so it's not quite as appealing as the one I mentioned before. But obviously this one's massively affected by the average returns. If their returns were better, then this one would be way ahead of the last one. So moving away from property, let's take a look at number 3 on our list, which is the NB Global Monthly Income Fund, ticker symbol NBMI. This one actually has a slightly less discount, which is also still fine, which is minus 8.25%. So it's still classed as being at a discount. And the dividend yield for this one is 4.46%. Now this is where we get into boring but traditional investment. Now don't run away when I show you this document. Now this one seeks to give you consistent monthly income in the same way. So it's 50 to 70% in traditional credit, meaning high yield bonds, and 30 to 50% in alternate credit, meaning special situations, which consists generally of tradable but less liquid debt securities. So essentially what this one is about is security, debt and loans, and it's using that money to give you the income on a regular basis. And it will be typically in corporate companies. I know it's boring, but sometimes boring can be really nice for investments. Now the issue is with this one, although it's more reliable, it doesn't give you quite as good returns, and I'll show you why. So here you can see the ticker symbol NBMI added, secure corporate debt loans is a category, the dividend 4.6%, the 5-year return is minus 2%, and the fee is 1.14%, so the return actually comes in at 1.32%. which actually gives you £11 a month on a £10,000 investment, which is almost half of BMO commercial property. But I would class it as possibly being more reliable, and that's available to buy on free trade. Now let's move on to the next one, which is a much better option, and in fact I think it's probably the best one on the list, and that is 24 Select Monthly Income, or SMIF. Now the only downside to this one is it isn't available on free trade, and I don't know why they've removed it because it did used to be on free trade, but it is available to buy on Hargreaves Lansdown and Trading 212. Now this one again is very similar. It's credit securities, bank capital, corporate bonds, high yield bonds, leverage loans, payment in kind notes and asset backed securities. Very boring again, but the returns on this one are actually fantastic. So the annual yield is 6.60%, which is really nice. The ongoing charge is at 1.12%. Now this is where it gets good. So if we take a look at the performance, so you can see the returns over 5 years, but actually if we scroll right down, you can see the average returns over the past 5 years is 10%, which is actually fantastic. So when we take that into consideration and we do the sums, so we've got the ticker symbol SMIF, secured credit securities, the dividend yield is 6.60%, the 5-year average return is 10%, taking into account the 1.12% fees, gives us an average annual return of 15.49%, which means for every £10,000 you've got invested, you can get £129. Now, as I said, that's not on free trade, which is disappointing, but it is on HL and it is on Trading 212. With that one, if you had £100,000 invested, that's £1,290 a month, which you can just see compared to getting £200 from this one is a massive jump up. Now let's move on to the next one on my list, which I think is the most sensible and secure, and actually if you don't want to take a lot of risk, it can be a fantastic middle ground. And this is the Vanguard UK Gilt ETF, or VGov. Now this one is an ETF rather than being a trust or being a REIT, but it still works in the same way with the monthly payouts. Now this fund's objective is to track the performance of the index, a market weighted index of UK gilts. Now if you're wondering what is a gilt, this is what it is. A gilt is fixed rate interest securities issued by the British government when it wants to raise money. With a gilt, you're essentially lending money to the government in return for a regular interest payment known as the coupon over a fixed term. The coupon is set when the gilt is issued and determined by the length of the time you wait for maturity. The further away from redemption date, the higher interest rate you'll receive as you're waiting longer to be repaid. So essentially, it lends money to the government and pays you an interest in return. But if you buy this fund, you just need to know what it is. You don't have to worry too much about that. You can just let Vanguard do the work for you. And it does have a very passive management style, so it's kind of a complete hands-off approach. So for this one, the figures do look low, but bear with me. So the annual yield is 1.14%, but the ongoing charge is just 0.07%, which does play a lot into the figures. If we take a look at the performance, we can see it's done really nice returns. It's been on an upward trend. Returns over 5 years, the average is 2.32%. So on this one, we've got the ticker symbol VGov, fixed interest securities and the government. The dividend again was 1.14%. The over 5 years average return was 2.32%. The fees were lower at just 0.07%. So the average return actually came much higher than the first three on our list at 3.39%. Now, what that means is for every £10,000 invested, you're going to get £28.25 per month. Or if you had 100,000 invested, that would be £282 each month. And that is available on free trade on the standard version. So obviously, when you take a look at this list, it's clear that this one would be the one that you would want to go for. You just want to make as much money as possible, but it depends if you're using free trade, if you can access this. If not, you'd have to look at maybe HL or Trading 212, but it also depends what you've got in your portfolio and what mix of companies you want to have. Now, you might remember earlier, I told you that I'm looking at UK companies because you don't have to pay that 15% tax that you would on American companies. So let me just show you as an example, if you picked one of these US companies, what you would get in return in comparison to these ones. And we're going to look at one of the most popular ticker symbols for monthly income, which is Gladstone Capital Corporation, or GLAD. Now this one, again, is corporate loans and it aims at mid-sized companies, which some may argue is going to be harder to get the money back from, but I wouldn't worry too much because it has some great figures over the past 10 years. So let me just show you the figures on this one in comparison. So we've got the ticker symbol here, which is GLAD, loans to mid-market businesses. The dividend comes in at 6.82%. Over 5 years on average, it's made 1.55%. The fees actually come in at 0 on free trade. You do have a small FX fee when you buy it because it's an overseas company, but it's kind of negligible. So the return on this one is 8.37%. So on £10,000, after the 15% deduction, you would actually get £59 per month. And that again is available on free trade. So I think what this does illustrate, you don't have to just look inside the UK. Some of these are fantastic if you can buy them, but what I am going to do from here is take this UK companies and do a comparison against some US companies and take a look at which are the best across the entire market. So if you do want to add some monthly dividends to your portfolio, stick around because there'll be plenty of those to come. For me personally, I may add some of these to my portfolio, but I'm not just focused on monthly dividends. I'm happy at the moment because I'm looking long term. I'm happy to wait annually or 6 months. It doesn't matter to me just yet. And what you can also do, which can be a really clever approach, is to pick a range of different companies that pay dividends at different times throughout the year. So actually you can get monthly dividends, but just from different companies. So you might get GSK one month, you might get Apple the next month, you might get them all in different months, but actually that provides you with your monthly income. And do remember, it also does depend at what stage in life you're in. If you're looking for these monthly dividends and you need it to live on, then you're going to be much better off with something like VGov, which is more stable, or a bond in general, rather than go for one of these companies that could pause their dividend for the year, and then you're going to be left with no income whatsoever. But with these companies I have mentioned are very reliable payers in terms of their monthly dividend because they either have to or it's in their nature, and that's what they're designed to do. If I haven't mentioned a company that you really like, please let me know in the comments down below and we'll share them, and together we'll build a collection of monthly dividend shares and dividend shares, and we can all add to our portfolio and build that great monthly income. Dividends can be a fantastic way to earn that passive income and generate the life of freedom you really deserve. The more passive income you can generate, the more freedom you have to do the things you really want to in life. So I hope you found this useful. Thank you guys so much for watching, and I'll see you in the next video.
I just wanna see the light.